Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about how to create your own pension. And we're going to take a lot of the concepts we've talked about up to this point and kind of put them all together to figure out what it is you're really trying to do with your money. But before we get started, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now, let's get started. Okay, in order to talk about creating our own pension, we do have to review a few different concepts. So if you remember back to some of the early episodes of the podcast, we talked about the purpose of investing. And we talked about the three things you can have in the different stages of life. And those are: when you're young, you have time and energy, but no money. When you're an adult in your working years, you have energy and money, but no time. And then when you're retired, you have money and time, but no energy. So when we talk about investing, we're trying to get ourselves to where when we hit that retirement phase, we will have enough money to be able to support our lifestyle. If we don't, if we miss that mark, we have to reduce our lifestyle, which is kind of the last thing you want to do in your golden years, right? So that's the purpose behind everything. So how do we make sure we have enough money to support that retirement? Well, you in retirement traditionally, for my parents' age group, which is now the kind of 80 and above crowd, there were traditional pensions. You could go to work for a big company, you worked at the same place for 30, 40 years, you left with a nice big monthly payout that would show up in your bank account without you having to do anything else. You earned that pension, or what some people call deferred compensation. So in your golden years, you simply collect checks. You also collected Social Security, and that was enough to meet your quality of living. Well, pensions were very expensive for these companies to maintain. So a lot of these companies got out of the pension business. And when you get out of the pension business, basically it put the onus on the individual to now save and invest during their lifetime to be able to reach the same point where they would generate the same cash as a pension payout. Well, they did that largely through IRAs, individual retirement arrangements. They did that through 401ks, 403bs, thrift savings plan. All of these programs were out and available, but the real concern was there was not a tremendous amount of education that went with it. So even though the programs were available, and we'll rehash some of the on time, on target numbers, but really there wasn't the financial literacy to go with it. It happened automatically with the pension. You didn't have to worry about it at all. The 401k, you at least had to get involved a little bit to get it started, pick an allocation, at least some involvement on your behalf to make sure your assets grow to cover that gap. And when I say gap, so I think of whatever it costs to live your life, say $100,000 a year, because that's a good, easy number for math. That's obviously a pretty good lifestyle. And if you get a pension that pays you $40,000 a year, if you were lucky to be one of the few that have a pension, and you had Social Security paying you another $20,000, then the gap would be that $40,000 a year that you would need to now use your portfolio to replace that income. So that's the math you're doing. You picture out how much it's going to take you to live in retirement. You work backwards, subtracting out Social Security, which if you've been in the workforce, you will have. I know there's some concerns about that, the value dropping off. It won't go to zero. I do think there's some adjustments that will need to be made, and it will generally affect younger folks, not folks that are knocking on the door of claiming. And if you're in it, I don't see anything happening to your payouts in your lifetime. So you're kind of grandfathered in. But if you don't have a pension, which very few of us do, again, I'm very fortunate. I served in the military, so part of my compensation was the pension that came with it, as long as I served my 20 years honorably. So if you have those, that's the math that you're doing. Now, if you remember back to our 5 things you must think about right now as far as your finances, which is another early episode, The first one was know where you are in the total number of engines working for you. So we talked about that, whether it's your primary job, it's your IRAs, your health savings account, college savings plan, maybe opening a business on the side. All of that's kind of irrelevant when you get to your retirement phase, which is what we're talking about today. And there, the engines that you have is kind of, you have Social Security as one engine that's kicking in a certain amount. And if you're married, you know, two engines that could be combined there. And there's all kinds of rules that go with them. And a pension would be another engine, excuse me, that you have. If you are still working, if you're able to work, and if you choose to work, that would be maybe, even if just part-time, we'll call it part-time. There's another engine there. And then the last engine, which should be the primary engine, if you've done everything, if you prioritized it during your working years, then your portfolio is going to be the primary engine. That's going to be the big number coming in the door. So kind of think of it as those four engines. Maybe you're not able to work, that takes it down to three engines. Maybe you never got a pension, that takes it down to two engines. You've got Social Security coming in the door, maybe a couple, you know, two of you coming in to add up to that one total engine there coming in from Social Security, and your portfolio. Well, obviously, if those are the only two engines working, you need to prioritize on getting your portfolio ready to go so you can support your quality of life when you get there. So remember, step 2 of our 5-step process of things to think about to stay on time, on target, was know if you're on track. So as a review, you know, by 25, get started. By 35, you should have an annual salary saved away. By 45, you should have 3x that salary. And again, a little bit of a moving target, I'll give you that. Think quality of life, if you will. By 55, you need 7 times that annual salary. And by 65, you need 15 times that annual salary. So where does all that math come from? As a reminder, if you have 15 times your annual salary and you turn around and take 4% withdrawal rate a year, add that to a typical Social Security payment, then that together basically is the income replacement you need to maintain the same quality of life. So if you made $100,000 a year, again, just to keep the math easy, most of your career, and you want to retire at that same level, i.e. stay in the same house, drive the same sorts of cars, eat out the same number of times during the month, do the same level of entertainment, you know, that sort of thing, then the 15 times your annual salary will deliver that pretty close to, at a 4% rate, that plus Social Security equals the same quality of life, so you're not affected. Obviously, if you have more than that, then you can either increase your quality of life, or you have plenty of money, you don't have any worries. If you have less than that, then you have to make some decisions about quality of life and how you can reduce your expenses, which you may not feel like doing when you're in your 70s. So that's knowing if you're on track along the way. Let's talk about a little quick refresher about the types of investing. There's the 401k, 403b, TSP type of investing, which you're doing most of your working career. If you're working for a big firm and you have hopefully you get a nice match from the employer and all that adds in, and you know, you can be a 401k millionaire. I live in Round Rock, Texas. We have Dell. We call them Dellionaires. Literally, you work for Dell out of college in your young 20s. You save 10 to 15% of your income until you can max out your 401k. You just max that out. You stay somewhat aggressive, and you're a millionaire at, you know, you should hit it around 50, to be honest. Most hit it around, you know, late 50s into their 60s, enough to retire on. So that's kind of the asset allocation piece. That is all what's called capital accumulation. While you're in the workforce, you're accumulating capital. The total return investing, which I kind of prefer myself, but everybody's different, that is more active, where you're getting into individual names, you're investing your IRAs, maybe you're getting into real estate as well, building wealth that way. Well, that is also capital accumulation. You're trying to grow your money. And then the one we talked about in the episode before last, combined with, you know, was dividend growth investing, combined with covered calls, is now the income generation / wealth preservation phase, i.e. we spent a lifetime earning this pot of money in our portfolio. Now we want to protect it and we want to generate income with it. And that's where it turns into that financial engine that we've talked about. And you start taking the steady stream of income, generally 4 to 5% in dividend income alone, maybe another 1 to 2% with covered calls. And now that becomes your income replacement stream. So that engine out there to, along with Social Security, and if you're lucky enough to have a pension and or a side job, side income, then all that adds up to the money that you live off of. And that's how you create your own pension. So as a review, even if you love individual stocks, say you love Amazon, well, Amazon doesn't pay you anything for owning it. So you can still have some of the big growth names because that's what got you there, that, you know, dance with the one who brought you sort of mentality. But as you transition into retirement, some of those names that you've had that are higher risk and higher growth, and you've been rewarded handsomely for it, especially if you're retiring right now. It's been a literal straight up market between 2009 and then this the act that we saw in March with COVID. 10 years of straight up market there. So you've built quite a nest egg. So now it's time to transition mentally into living off of that, which is now where you're looking for those dividend growth companies, which we talked about in depth. So I won't go into it too much other than the math behind it. So say you have $1 million portfolio, again, to make the math easy, if you can generate 5% off of that portfolio, which you should be able to with your dividend payers and covered calls, should you choose to do that, that generates $50,000 a year to live off of. So divide that by 12, that's $4,000 and change dollars a month. Add that to your Social Security that's coming in, and that's what you live off of. That's your quality of life. If you can generate 6%, which you can, but now you start getting into, it takes some skill to do that. Then now you can make $60,000 a year. So divide that by 12, that's $5,000 a month. So if your skill set is such that you can do this, you can generate almost another $1,000 a month. And again, to get beyond that, you can do it. It's generally, you end up taking more risk, and then you could argue whether you should or you shouldn't, such as a company that pays out a 14% dividend. Generally, they're in trouble because you just can't continue that forever. But that's what you're doing. You transition that big pot of money, and it is what it is. You can't go back in time and change anything. If it's $1 million, you retool the portfolio to generate income, and that's how you create your own pension. Okay. We talked about covered calls. I'm not going to go into depth here. That was last episode. Again, a little bit confusing. Some people are scared of that. Don't do it if you don't like it. However, it is a good way to simply generate more income and get another % or two out of your portfolio. If you're in retirement and you're hurting for cash, it is something for you to explore. So to recap, you spend a lifetime to get a big pot of money, which you then retool to be able to live off of the income. That is the pension generation piece. That's what we're talking about. If, however, you have to cut into principal to fund your lifestyle, realize you are now on a trajectory where you will run out of money someday. Now maybe you're okay with that. Maybe you don't want to, say it's a $1 million portfolio and you live off your portfolio and then you pass $1 million on to your heirs. Maybe you don't want to do that. That's up to you. Well, you need to be good at math or involve somebody who can kind of talk about when it is you're going to run out of money and run the Monte Carlo analysis to see when that is. Okay, so this again was all talking about not cutting into principal. And again, that's a nice safe place to be. So the last thing I do have to talk about is, well, I hear all this, Steve, that you're saying, and it seems like a crap ton of work. And to be honest, it is. You have to have started it when you're young. You've had to stuck with it through the ups and lows that life has to offer. You've had to maybe even ramp up towards the end during your peak earning years in your late 40s, 50s, maybe 60s, and really kind of maximize it so you have this nice big chunk. It doesn't happen magically, otherwise everyone would do it. So yes, it does take some work. And now to go in and retool all of this into generating stuff and have to worry about companies and dividends, okay, there is another answer. You can forego all of this, and that just means at the end of, whenever you retire, you simply call your local insurance person, or maybe they're crushing your inbox like they are mine, because now I'm a member of AARP at the ripe age of 50 with trying to sell me an annuity. I'm not against annuities. However, just realize that it's not a service they're providing, it's a product. And there's a difference when you buy a product. You are buying a contract. So you could take yours, say it's $1 million, and live off, do a little bit of work or hire somebody to do it for you and have it generate that $50,000 to $60,000 a year without touching principal and live off of that. And at the end of the day, eventually you will pass away, as we all do. That $1 million is still there, and it goes to somebody, or your parent, or whoever you want to leave your money to, or to charity, whatever you decide. But the money is still there, and you retain that money the whole time. With an annuity, you are going to take that money that you have spent a lifetime building, and you're going to sign it over to an insurance company for either an immediate annuity, which they'll turn around and start. So you kind of think of it as almost like a little kid to an adult. It's like, I'm going to give you all my money, and the agreement is you're going to give it back to me a little bit at a time over the rest of my life. Okay, that's an immediate annuity. Or you can do a deferred annuity, meaning I'm going to give you this huge chunk of money. We're going to wait a little while where you don't give me anything, and then you're going to piecemeal it back to me for as long as I live at a certain rate. Whenever you think about, am I getting a better mathematic deal than if I did this myself? The answer is never. Not once, not ever. Because the insurance company are the ones who write the contract. They present you the contract. You don't draw it up and present it to them and see if they sign it. They draw it up. They have actuaries that work for them in mass, right? So they understand that for them, it is a positive expected value arrangement. You could live to 110, sure, and get the better end of the deal. But on average, everybody in aggregate, there is not one single contract that they draw up at the point of signing where they're accepting a negative expected value. Which means if they're always getting a positive expected value, you ergo are always getting a negative expected value. So it is never mathematically you're the correct choice for you. Now, that being said, I would never do it. But if you want to transfer risk, which is what you're doing as well, say you don't trust anybody, I want the guarantee. You can't stand markets, you don't like the ups and downs. You don't want to have to work. If you're passing the risk, as long as the stress and everything, you can take all of your money, and not all of it, but a large majority of your portfolio, turn it over to an insurance company and enter into a contract. And at the end, when you expire, the contract expires. Originally, annuities did not have survivor benefits, so your family got nothing. Now they have survivor benefits. Well, guess what? You're getting less every month if you have to fund a survivor benefit. So it's kind of like, why do it at all? It's up to you. I'm not trying to talk you out of an annuity, but mathematically just realize if you enter into an annuity, you are not getting the best option. So that's what I have for you today. So think about, again, it's a review of a lot of the concepts that we've talked about as far as what's the purpose of investing, what am I actually trying to do with my money, how should I stay on track throughout the course of my life, so what things will look like later on is what I want my life to look like later on. All those tools put together is how you create your own pension. So that's all we have for today. Please reach out to me through ototnow.com if you have any questions or comments. Thanks again for listening in, and here's to you fighting the good fight every day to be on time, on target with your financial goals. Bye.